We've just seen one of the largest breakouts within the US market at the moment, and this is, of course, OSCR Health. You've clicked this video for that exact reason. So in this video, we're going to be going over why exactly OSCR Health could be a generational pick right now. For me, I don't think this stock has a massive upside for this year's growth, but if you do price in the future potential within this stock, then there is definitely a strong case for a buy-in. We'll be going over all of this in this video, but to start off, let's see why exactly OSCR Health is currently rallying and looks to be a solid buy. OSCR Health is a tech-driven health insurance company focused on individual and small group plans through the Affordable Care Act, otherwise known as the ACA. Unlike traditional insurers, OSCR is digital first, using its in-house platform to make enrollment claims and doctor interactions easier and more transparent. Think of them as the Stripe or Square of health insurance, streamlined, user-friendly, and AI-powered from the ground up. Right now, they currently serve over 1 million members across 18 states. So who can we compare OSCR Health to for differentiation and the competition? Well, their main competition includes healthcare giants like United Health, which recently fell down a massive amount, Centene and Everlance, but OSCR's edge lies in its tech-first infrastructure and efficiency. Whilst bigger players often rely on legacy systems, OSCR uses automation and smart algorithms to cut costs and improve care access. That lean approach helped them reduce their medical loss ratio to just over 75%, one of the best in their category. This company recently posted a surprise profit in Q1 of this year, earning over $270 million in their net income after turning profitable for the first time in 2024. But what really stands out for this company is what has already been approved to help this company grow further, such as the expansion of ACA Marketplace under the Biden administration and strong support for individual marketplace subsidies through 2025. These policies directly support OSCR's customer base and potential growth. So I know what you're thinking, this doesn't sound massively exciting so far, but here is where the excitement really starts. There is growing political support for a new public health insurance option, such as a Medicare Part E, which could massively increase the number of people on individual health plans. OSCR is well positioned to capture a big slice of that. If this passes, this company isn't just going to grow, it could double or triple its customer base. And if you want another driver, institutional interest is growing and the company is approaching positive free cash flow. So a break above $20 to $22 could set off some serious momentum, in which is what we have already seen. And the odds of all of this going in OSCR's favour are higher than you might actually expect. The public option is gaining traction. The ACA enrollments are at all-time highs, and OSCR has already got the systems and state licenses in place to scale very quickly. They trimmed losses, improved operational efficiencies, and executed consistently, which is something that even larger competitors are struggling with in this market. And finally, the CEO, Mark Bertagnolli, which I hope I'm pronouncing right, and another company in which I'm going to struggle to say is Aetna, probably also pronounced that wrong. He was the former chief of this company, and he brings serious experience and credibility to OSCR. Under his leadership, the company has gone from a money-losing startup to a disciplined, fast-growing operation. He's focused heavily on operational rigor and has made big moves to improve both profitability and growth, all while maintaining OSCR's tech-forward DNA. His track record in health insurance makes OSCR one of the most well-managed small caps in the named space. So if you are looking at OSCR Health, you are not just investing in an insurance company, you're investing in a digital disruptor in one of the most heavily regulated and high margin industries in America. If policies fall into place, this could be a major breakout stock, even though it already technically is. But even without them, it's a lean business model, and improving margins are definitely worth watching closely. Okay, so it all looks to be heading in the favour of OSCR Health at the moment with the current political stance, especially with Trump being in power, as OSCR Health does actually have intrinsic links to Donald Trump and his family. So it does look to be something in which could definitely see potential upside if policies do continue to go through. But From here on in this video, I'll be going over my opinion and why I think this is a good buy. I'm going to be starting this off by looking at my intrinsic value formula, and to spoil it for you, it actually isn't as bullish as you might have thought, especially if you are a long-term viewer of this channel. You'll know just how bullish this formula can be, but we will actually explain why I think that this could be slightly off in this case. Right, so starting off with a retention rate here, we can see that Oscar Health is currently coming in at a mean of 2.2% over the last few quarters for a retention rate, which obviously isn't massively ideal, but on a liquidity ratio, they're currently at 6.33, which means for every dollar of debt in which this company owes, they have $6 to pay this back in liquid cash. Looking at their quarterly free cash flow here, we can see that this is relatively positive consistently, and it is actually looking to be consistently increasing as well, which is also incredible. If we do look at an exponential 365-day trend line, we can see that volume is correlating really nicely with the current price, and we are looking to be above both of these trend lines, especially with the close of the last couple of days within this stock. If we do look at the probability of a positive day for Oscar Health, we can see that a positive day comes in at 48% with a negative day coming in at 43%, indicating that based off of the last 365 days, we haven't actually seen much positive momentum, which is obviously clear, but this is a very, very new breakout stock. If we do look at the 90-day price here, we can see that we are above this trend line as well. And looking here at Graham's formula, this is where we can see that this stock looks to start to look a slight bit overvalued. So currently, on the bullish side, the intrinsic value is set at $25 with the current price coming in at $21. That indicates that there is still a bit more room to run, but when you margin in a margin of safety of 25%, this puts us in at a sell with the acceptable buy price coming in at 18. On the right here, we can see that the intrinsic value is only at 13, so it's fair to say that according to the average of Graham's formula, this stock looks massively overvalued currently, but the high side there is still potential. Looking at Peter Lynch's valuation, this comes in at fairly valued, and if we look at my formula, this puts a price in at $25 as well for the high side, and this accounts for way more. It accounts for the free cash flow, it accounts for the retention rates, the liquidity ratios, and it also accounts for probability of a positive day and many, many more things. There's the formula if you are interested and actually can read my handwriting, but for me, that's why I'm struggling to see that this is a massive outrun for this stock, but we will get on to like future aspirations for this company with their forward PE in a moment. If we do actually look at their free cash flow, this is where this company looks absolutely incredible. So currently they have a discount rate of 8%, and the almost exponential increase of their free cash flow over the last 4 years has basically led my analysis to come in at this year should be worth nearly $300 based off of just their free cash flow. So if you are interested in these overall results, here they are. So currently, as of recording this, Oscar Health is at a PE of 53, which indicates that it looks to be slightly overvalued when compared to its its peers to an extent. But when we do look down at its forward PE, this comes in at only 30. Now, this is still relatively high, but I do think the trajectory for this company does actually justify this. If we do go to the analysis tab here, we can see that this company is expected to grow 74% over the next 12 months, which is absolutely incredible. And looking at their surprise rate, this is a bit volatile. We've seen it go from highs of 30% surprise to lows of minus 25% surprise. So it's hard to really call where they will be priced in on their earnings. As you can see here, they missed these two earning reports in November and December. So it looks to be as if there is a bit of questioning around if they are going to be able to consistently beat their earnings. But despite this, we have actually seen the stock rally. So doing somewhat of a chart analysis here, we can see that the stock price was in two bull pinches here, and the final one resulted in this parabolic growth, and we are now above all of the exponential moving averages with, if you can really just about see it, we have now seen a golden crossover as the 50-day EMA has crossed over the 100-day EMA, suggesting that the MACD has now crossed, indicating there is a lot of room for potential growth. So we have actually seen this stock actually close consistently positive over the last couple of days, but I think it's fair to say that short-term pullbacks are still very, very likely, and I expect next week to be somewhat of a sideways, if not downwards week. If it does go up, which I do hope it does, but I would be very, very amazed. I will be honest. I think seeing a massive amount of growth like this in such a little amount of time, it's not one of the most, well, sustainable things in the world. So in the last week, we've realistically seen the stock go up 52%, which is absolutely crazy. So currently we are actually seeing articles such as, is this the market's next meme stock, which I think is very much so a bit unfair for a title, but it basically goes on to say that it's not. There is a lot of company fundamentals underneath this current buy-in action. So, and of course there is a lot of technical signals in which are going to drive a lot of large investors to actually pile into this stock, as a lot of these hedge funds and big buyers will wait for the 150-day EMA to be, or SMA in their case, to be below the current price, indicating that there is genuine support under it. So we can see here these lines are indicated to be back then they were actually levels of resistance, but this stock just absolutely powered through, and I do think it's fair to say I do think this stock will just continue to go from here. If we do actually look at the analysts' price targets from around the start of last week, we saw that the price targets were only set at an 11% upside from there at $18 on an average, and there was a high side of 27. So it's fair to say this stock has just absolutely exploded past the majority of these, with it probably going to be chasing this high end. Will it actually reach it? Probably, and it might actually surpass it, but that will indicate that this could start to look very unsustainable very quickly. I think realistically what it will all lead down to for Oscar Health is how quickly it goes up. If it goes up too quickly and volume isn't correlating properly, then we're going to see this stock being massively overbought, indicating that this can fall down as quick as it went up. But I think it's also fair to say, if we do see this stock start to just gradually climb up over the next coming months, then I think this stock will look a lot more sustainable. If you are thinking about putting a lot of money into this company, I do think there is currently better companies, but this is definitely still a really, really good pick for a long-term play. But I do think you will see a lot of volatility in this stock in the coming weeks. Realistically, we want to see a similar situation here to Hims and Hers, where it climbed up a massive amount, did a bit more, and then it just went sideways, as this is where all of the swing traders will get bored and essentially sell out, indicating that every bit of volume within that stock now is sustainable. They are genuine investors, and that is what you want to see. I think currently Oscar Health is definitely accommodating a lot of swing traders, and that is something in which will definitely affect the sustainability of its current price increase. So that is my opinion on Oscar Health. An amazing company, an amazing long-term hold, but the sustainability short-term could be within question depending on where it moves in the next couple of day closures. So with that being said, none of this has of course been financial advice. This is all just my own personal opinion. With that being said, I really do hope you have enjoyed this video and would love to see you around. If you could hit a subscribe and a like, that would be greatly appreciated. I do videos like this every other day, and I do not earn a penny off of YouTube at the moment, which if we just realistically say how that makes me feel, then we can pull this out here, and that is how I feel about it. So with that being said, I will see you for the next video.